So one of my clients just came to me. He inherited some money from his mother. It was about $200,000 or so. And he wanted to know kind of where to put it. He's been hanging on to the money for a while, thinking about buying real estate. It's just not in the cards. He's losing money by not having invested. He wants to know where to put it. He talked to his bank. The bank only told him about CDs, or they wanted to lock it up in some long-term, 10-year annuity contract. And he didn't want to do that. He wanted to do something a little bit shorter term and paid some interest. So after talking a bit about it, we decided that we wanted to have about half the money in something that's going to give me a guaranteed interest rate. After that, he said he wanted to only lock it up for about 3 years. First thing we were going to go through, for him that gives you guaranteed interest that isn't based on markets or anything like that, we're looking at these MYGAs, which is multi-year guaranteed annuity contracts. They're very similar to a CD. Only difference is you buy them through an insurance company, and the interest earned goes tax deferred. They are insured by SPIC, not the FTIC. So they still have some insurance on them. It's just a different institution. So we look at here, we got 3-year options. These are all the different companies. We have how they're rated, max age, minimum purchase amount, how long it is, can we get any money out before the contract. So if it says 0 means no, 10 means I can get 10% out any year past the second year. INT is interest only. The last time they updated these changes, and the current rates. So if we're looking for, what's paying the best, we can see here that we have 2 at 5.25. So those are 2 we would be considering. Next thing I'm looking at is minimum purchase. We're putting 100,000 in, so we meet both of those. Max is 90. This guy is about 70, so we're fine here. They both have B-rated companies, so they look to be about the same. I'm not familiar with these top guys. These bottom ones I've known for a while. The way I would look at this is just do a little more research on it. This system makes it pretty easy, so I can see ratings. AM Best has my B++. If I go down to this next one, AM Best has B++, but they're rated by 2 other rating firms, and they have A- there. One, I'm more familiar with them. They've been around since 2005. They're rated at A on 2 other rating institutions. Tells me that there might be the better way to go if they are going to pay us the same. In the end, whatever is going to pay you the highest, it doesn't matter too much. So we're going to end up going with this one here. That was just half the money because we wanted guaranteed interest on it. Now the rest of the money, we wanted to gamble a little bit with it. Just want to be safe, but we're gambling, rolling dice just a bit here. Other options that we looked at was this thing up here. It's called a market length growth CD. So just like the CD you get from the bank, except instead of getting a guaranteed interest rate, we're going to tie it to the market. So in this particular case here, we're tying it through the SPS or the S&P 500 index. So you're not taking risk. We're not investing directly in the market here. That's just what the interest that we get on the CD is going to be based upon. So we see here it says max loss is 0%. We're not risking our principal, and it is FDIC insured. So we still have same FDIC insurance as you could see to get through the bank. We're not risking any principal here. The only thing we're risking is the interest rate. If I go to the bank and they pay me 4% guaranteed, and this thing, S&P is negative for the next 3 years, and then I get my money back, I would essentially be giving up that 4% I could have got elsewhere. So you're only risking the potential interest of the bank. But if you look at the upside, we see that we're going to get 1x, or basically dollar for dollar, up to 17%, and this is a 3-year CD. So essentially I can earn up to 17% over the next 3 years, as long as the S&P 500 is up more than that in the next 3 years. So if you think the S&P 500 is going to be higher than 17% than it is today, in 3 years from now, this is going to max out there, right? So 70% over 3 years, it's a little higher than 5% per year. They do have other options. I do have this sorted by 3-year terms. If you want to go longer, there are more options here. The other option showing us is these other indexes. I'm not very big on these other indexes. You can see it pays 1.85% and it's uncapped. So meaning it doesn't matter what it does, they're going to give you 1.85 or 85% on top of what it does. So if it goes up 10% over the next 2 years, you get that 10% plus another 85% on top of it. So basically you get 18.5% on it. So it sounds really good. They're not going to cap it. My thought and my experience with indexes that do this is the reason it's uncapped and why they pay so much is it usually doesn't do that great. They don't run that high. They do a few percentage points. That's just my experience with it. So I tend not to use any other indexes, but anything like the S&P, I'm a bigger fan of. So that's market length growth CD. We decided to put some money in there. If you're wondering, how do I get into one of these growth CDs? This is not something you buy from a bank account. You can't go online and just buy it from some random vendor. You can't call Vanguard up. These are custom contracts. You have to have some type of licensed advisor that can come on here, grab the QSIP number. This is like the order number to put in. All these things don't trade until the end of the month. You can see it says 9/30, but books closed, trade date 9/30. So when I put the order in today, it won't trade until the end of the month. So it just kind of sits in limbo. It sits in the order books until it's time to trade. And as far as, fees go, these all say, if you look in comp type here, it says all fee-based. Fee-based just means whatever investment account this is going into, you just pay whatever fees on top of that account, the management fee. So if the advisor charges 1%, it's 1%. If they charge 1.5%, it's 1.5%. These are not commission products. You don't get paid anything extra for using these, or I don't per se. They're all just part of the investment service that we provide to the client per what they pay for. So when you're looking at, advisors, what they charge, they'll always look at their portfolios. The ones that go and do the extra stuff and have these other custom contracts in there versus those that don't, even though the fees are the same, one might be doing more work. So just something to keep in mind if you're shopping around. The other one I have it pinned here, something called a protected callable market link growth note. Now that's a mouthful of jargon. I don't expect you guys to get it, but to break this down, protected means we're not at risk. So if I look here, it says we have issue protection 100%, max loss is 0. So we're not taking any risk here. Next phrase, callable, means they can get that money back. Even though they say, hey, this is a 3-year deal here, at any point they could say, hey, I don't want to pay out this anymore. I'll just give you a lump sum and I get my note back. They recall the note. So essentially it's like a buyback program. In this case, you see the upside participation is 1.5% uncapped, because it's going off of this weird thing, S&P 500 futures, volatility, some goofy index. All right, so if the index keeps performing, we get 1.5% whatever this does. If it goes to 0, does nothing, we at least get our money back. It tends to increase. And let's say they're on the hook for more money than they want. So if it does do well and they're looking at this like, man, we got to pay this guy 50% more than what we're making. It's probably too expensive. Let's just buy them out. Then they issue a call. When they call, they give you this interest up front plus your money back. So I put $10,000 in here and they called it. They would have to give me my $10,000 back plus 12.5% of interest. And then I would get that money back and I could go buy a new note. Now this can happen at any point. It all depends on the note and their terms. So it says non-call year 1. So the first year they can't call it. So the first year I'm going to get 1.5% or whatever the index does. That's year 1. After that, 1 year, 3 months. So every quarter, you can see they're issuing calls every quarter. At the beginning of every quarter, they have the option to say, yes, we're going to call back, or no, we don't. Every year it goes past it, this thing stacks. So it says 12.5 PA. PA is per annual. So every quarter, it's kind of blurred out here with this thing, but it's basically 5. Any other quarter past the first year, basically, they can call it any quarter and they would pay you the interest rate on it. Now, if they call it in, say, quarter 6, a year and a half in, they would have to pay you 12.5% for the first year, and they owe you half the interest for that second year. So you'd make about 6% here, about 18% overall. I like this option just because it's a little different. We're still protected. We can still be in the market to a degree. If it doesn't work out, we're protected. If it works better than they expect it, they got to buy us out at 12.5% interest per year. So they want to call this at the end of year 2, they're on the hook for 24%. At the year 3, it's 36%. So in a way, you kind of hope that it gets called. This isn't probably my favorite option. He just wants something shorter term. If I got something that was a longer term, just so you guys can see what options there are. So when we go to like 5 year and stuff, then we start getting the S&P 500 back. This S&P 500 futures, a little different, but at least follows the S&P to a degree. We still have the same protection. It's just 5 years. They can't call back to year 1. Call premium is still 12%. So basically every year it goes by, this is a monthly call. So any given month, they could call it back. And every month that goes by, they don't call it, they owe us an extra percentage point. Upside is 1.6 in this case. When do they call it? This one says issue discretion. This one says if it goes more than 100.5. Whenever you buy it, that's considered 100%, right? What you bought it for. If it goes anything up over 0.5% on the annual, in this case, they reserve the right to call it. They would owe us 8.75% in this case, or an additional 0.5% on top of that for a year past. So you can see there's a bunch of different options when it comes to where do I invest for safety. So this is something that we are using for him as well. They got more growth notes, income notes, things that are protected, not protected, but just to give you guys the behind the scenes of the research that we do or shopping around to building out these safe, more conservative portfolios. So in this case, we're putting that 100,000 into this MYGA product here that's going to pay him 5.25. We're putting another 50,000 to this growth note that we could potentially earn up to 17%, potentially, but the money's still protected regardless. And then we're doing this one that we'll see either we get called or it's 1.5% or 1.5% what the market does. So this is a little more of a gamble, sort of. You're still protected. We're just gambling the interest here. So it has the potential to work out really well. At worst case, we get our money back. So we're definitely putting money into this one as well. So if you guys have questions on any of this, if you've got money sitting on the sideline, you're like, hey, I want to invest it, but I don't know where to put it. I don't want to take any risk with it. I have got monies and CDs that are maturing. I don't know what to do. Then just send me a message or comment online and I can help. We can set up a time to go through this type of detail for your plan. This is part of the course that I'm building out. It might be part of the advanced series, which is going to be a part of the paid group. So if you're not part of the premium group yet, this type of information and details will be posted more in that realm. All right, so again, if you have any questions, just drop them below this video. I'm happy to help where I can, and talk to you guys soon.